Good morning. Well, let's try it again. Good morning. That's really for me. Anyway, so many of you have come to this seminar over the years and have seen me talk about asset allocation, diversification, and also handed out a lot of warning. So what I'm going to talk about today is towards the latter. Mainly the topic I'm going to discuss is on investor behavior and, more importantly, financial decision making. Okay? If you want to make decision, you need to know some benchmark, right? See, you need to understand basically you're comparing something to a benchmark. So I'm going to give you 4 numbers. Okay? So these 4 numbers are very important numbers. Okay? I like the number 3. Okay? 3 is a good number. Small, medium, large. Right? So good things comes in 3s. Yeah? Having taught for so many years, I like to break things down into bite sizes. And 3 seems to be a good a number. So 3 is an important number, because it's also something I'm going to talk about today, because I've got about 3 different topics. Okay? I'll elaborate later. And 3 is also a very important number, because 3 is over the long history of the developed economy, 3% seems to be the number for expected inflation. Okay? So 3 is an important number. So what is inflation? Inflation is ever increasing prices. Oh, Prof, I beg to differ. Chicken rice price just went up, 50%. Okay? No. Okay, I'm not talking about, just over the past few years. Okay? We are talking about long periods of time over the entire history of the developed market. So 3% is important because that's the baseline. That's the expected inflation number. Okay? Now, so what happens if you put your money under the mattress? Right? Some people do that. Right? They put money under the mattress. The money is growing at how many percent? It's 0%. Okay? But prices is increasing at how many percent? 3%. Okay? Right? So what happens if you are just putting money under your mattress? After a while, your standard of living goes down. Right? Because prices are going up. Your wealth is not growing because it's under the mattress. Okay, so that is 3%. Okay, now there's also another number that's important. So we have number 3. Okay, another number that's important is basically, if let's say in this room we are the economy, and people have money to lend, and then people want to borrow money, and then there is a system of bidding going on, eBay. Right? I got some money to lend, who wants to borrow, and then we argue, and negotiate, and ended up. So the economist tells us that in a world without inflation, without anything, right, when there is a exchange of value over time, right, it is around, varies around 1%. Okay? So now you have 1%. Right? That's just the exchange of value over time, right? Per year. So you add that 1% to this 3%, now how many percent do you have? 3 plus 1 is 4%. So 4% is an important number, because 4% basically on average tells you over the history of the developed market is what you get if you invest in a security that is somewhat risk-free. Okay? Right? Not exactly, but over the long history, the professor will tell you, it is around there. Okay? Now, another number. Right? This time we add another 2%. Okay? Now we are in the region of 6%. So what do we have now? We have 3, we have 4, and then 6. Right? Okay? So 3, 4, 6. Okay? So 6% basically will be a number that if you were to invest in a so-called, corporate bond, in the US, okay? Right, this is basically a lot of the context in the US, but it kind of helps you make good decision, if you have this number at the back of your head. Because it goes from inflation of 3%, risk-free of 4%, and now the 6% will be investing in somewhat riskier corporate bonds. Okay, so if you put money in corporate, but Prof, putting money in corporate bond is, it's almost half a quarter of a million a pop. Right? Nowadays they have retail bonds. Okay, so but those are good instruments to be in. So in the U.S. context, now you're looking at 6%. So you're 3, 4, and 6. And you remember the risk start increasing. 3% is inflation, 4% is risk-free, 6% is corporate bond. So risk is slowly going up. Okay. Now the fourth number. Okay. So this one I have to wait a little bit, worry a little bit, because depending on what number I tell you. Okay. So I'm going to tell you 10. I really want to say 9, but then somebody's going to run out and buy 3, 4, 6, 9. Okay? Then I'll be in trouble. Okay. So I better say 10%. So you can't go buy 3, 4, 6, 10. Okay. So 10%. What is this 10%? 10% is over the long-term average of U.S. equity. Okay, over the last 80 years, if you look at the numbers, around 10%. See? But you know that when you put your money in the US equity, what happens? It's very volatile, right? Okay, it goes up, it goes down, it goes up, it goes down. So if you execute a wrong trade, where you buy high and you sell low, okay, it is not 10%, but it's negative 10%. Okay? Right? But if you keep over the long period of time, it's around 10%. So you have 3, 4, 6, and 10. Okay? If you remember this number and keep it at the back of your head, right, I think you'll be able to make, good financial decision. Wow, that's the end of the talk. That easy. No, there's some more good stuff here. Okay? So, first thing you want to know is really, I talk about three bite size. Right? I always come up here and talk about asset allocation and diversification. Okay? The previous speaker talked about ETFs. One of the reasons you want to invest in ETF is because of this. Diversification. If you buy a company stock, okay, and then you read the news, that company's name is in the news, okay, you sweat. It says something wrong with the company. You are taking on those company-specific risk, right? But if you buy ETF, where it is a basket of companies, then you don't have to worry. Don't even need to read the news. Okay? As long as the economy is doing well, the market is doing well, that ETF will be doing well. Okay? Right? So that's one of the beauty of doing this. I don't want to get into the theory and the logic behind diversification, but this is exactly what grandmother said. Don't put all your egg in one basket. Right? Okay? Grandmother knew it. We the economists proved it. And Harry Markowitz won a Nobel Prize for writing it down. Okay? So, anyway. So, can't stress enough the importance of asset allocation. Asset allocation, basically, according to some of my colleagues, who wrote a paper, show that, he explained 91.5% of the variation of the performance. Right? So, what is asset allocation? Asset allocation is basically look at your entire wealth and then decide to where to park the money. So let's say, this is hypothetically, okay? Just an example. So don't try this at home, okay? Right? Some people, this is not one size fit all, but it's just an example. If you park 29% of your money in stocks, 24% in bonds, okay? And we like gold, right? Like the color of that precious material, 18%, and let's say the other 29% in cash. Let's say this is your portfolio, okay? And let's start a simulation. Let's say we start investing 3rd Jan 2012 and put down 100,000 big ones, okay? And then let's see what happens. This is the portfolio, and if you simulate it, and then you look at what happens, and you use ETFs, right? Why you want ETFs? Because, automatically you get diversification, okay? So you can basically don't have to buy a lot of stocks, just buy one ETF, and you can basically buy another kind of a bond ETF. You can buy gold ETF, and you basically, form that portfolio, and assuming that cash is not earning any returns, right? And you form this permanent portfolio and you track and see what happens. Okay? Right? You say, but Prof, okay, if only I put all of my money in the stocks, wow, 23%, okay, wow, I lost a lot of money in gold, okay. See, this is because it's from 3rd January 12 until 3rd March 2015, okay. During this period, it is like this, but if you look at other periods, it's very different. So the whole idea is don't be too greedy, okay? Unless you can predict the future as to what is going on, right? The best you can do is to form a diversified portfolio and earn, on average, if you put your money in the equity market, you should earn around how many percent? 10% on average over a long period of time, okay? But if you have a kind of a balanced portfolio, then maybe, something like this. But this has happened over this period. Okay? Remember, period is very important. Okay? Now, so, what to do? A lot of people ask me, so Prof, what do you do? How do you balance your portfolio? Okay? I said, well, I kind of don't look at it. Right? Too busy with other things, right? Student complaining, writing exams, grading exams, okay? PhD student, Prof, any research ideas and all that. So don't really need to go back. Fortunately, I don't do this for a living. So you don't have to rebalance it every other day. As a matter of fact, you don't even want to rebalance it every year. Okay? Every 2 years, maybe a good starting point. Look at your portfolio every 2 years, and then figure out, right? Every 5 years, you do a more in-depth study to look at your asset allocation. Meaning more money in stocks, less money in stocks. So as you get older and older and older, moving towards retirement age, you take out more money from your stock and put more in bonds, okay? Because you do not want the volatility, okay? Right? You want to be able to sleep at night, okay? So one way to rebalance it is to do a calendar rebalancing. Another way to rebalance is to do kind of a threshold rebalancing where this is your target. Let's say your target is 50-50. But if equity market move up, right, then you have more equity than bonds. So, you think about a 10% band. If move out of the band, then you rebalance. But that means every now and then you have to go and look at your portfolio, right? And sometimes, the whole idea of buying ETFs and buying a diversified portfolio because you don't have the time, okay? People often discount, don't think about the value of time. Okay? Oh, time is free. No, time is not free. Okay? Time is like oil. It's a finite resource. Okay? Right? You have to price that in. So every minute you spend studying a company, thinking about who to invest, right? That costs money. Right? Well, but Prof, it's time. No, there's opportunity cost. Because you could be, at McDonald's flipping hamburgers for, maybe $6 an hour. So 1 hour costs $6. You think about it that way. Eh? Oh, no, don't bring this back and say, oh, honey, I don't have time. Okay? If you want my 1 hour, $6. Okay? Some opportunity cost. You have to think about that. Because some people really don't think about time like a resource. Time is a resource. Okay? And we are, kind of busy people. So, so we can't be spending a lot of time, researching a company. Some people do that for a living, but most of us don't. Okay? So things like this are kind of important. Calendar rebalancing or threshold rebalancing. Pick one. Is there a right way to do it? No. Okay? There's no wrong way. There's no right way. It is just your way. Whatever works for you. Okay? The whole idea is don't look at it every other day. Okay? And you got a life to live. Okay? Now, next thing I want to talk about. That one is on asset allocation. The next one, the important one, okay, is on decision making and financial planning. I already give you this tip, 3, 4, 6, and 10. That forms the benchmark for you to think about things. Okay? For you to think about, an investment, how risky the investment should be, and what should be the expected return. There's a big difference between expected return and the actual return. Actual return can be all over the place. But when you go into the market, you buy a security, you think about what is the expected return. Okay? Now, we think about decision making, see, you have to think about opportunity cost. Right? That $6 an hour, that time of $6 an hour, every hour you put in, there's an opportunity cost. Right? This is a very important thing that normally people don't even think about when they're doing things. Then you have to consider the risk, then you look at the alternative, and then at the end, measure what are the consequences. These are kind of the stepping stone in making good decision. Okay? Just like 3, 4, 6, 10. Those are the benchmark. Now, if you look at decision-making process, the standard thing that, you look in the textbook, they tell you, identify your goal, establish criteria, pro and con, make decision, and then evaluate, and then go all the way back again. But the financial planning is kind of the same, right? You set your goals. Okay? Chris will talk about setting goals, right? I want to retire as a millionaire, okay? And that is my goal. Okay, that's a good goal, okay? Let's see how we are going to achieve it. Then you basically create a plan, right? Implement the plan, and then monitor and modify the plan. Okay? Some plans are feasible, some plans are not feasible. Prof, I want to retire, a millionaire with 1 million. I only have 2 days to do it. That's not going to happen. Okay? Right? Only in your dreams. Okay? Right? So you have to plan. You have to have a long-term plan. Now, I like this slide. Okay? And this is what happens to a lot of people who don't understand the market, who listen to their friends. Okay? Every other person that tell you they make money in the market, there are 10% that lost money. Okay? The one that's losing money basically don't say. So you only hear people talk about winners. Okay? Those who lose basically, they don't want to say. Okay? Face issue. So if you think about it, you can think about the market. Market is always kind of a cycle. Up and down and up and down and up and down. But if you look at the long-term trend of the stock market, it has only one way to go, which is up. Okay? And in previous seminar, I talk about why is it up. Very simple. And you think about years and years and years ago, right? And some of you have heard this story before. If somebody, from China wants to communicate with some guy from Singapore, so what does the person in China do? If they really need to talk to the person in Singapore, let's say, 800 years ago, you find a bottle, write a message, put it in and throw and pray. Right? It may get there, it may not get there. Right? Fast forward 800 years later, today, somebody in China wants to talk to somebody in Singapore, what do? They take out their cell phone and they can call from anywhere. Okay? Right? You look at technological progress, people can do more with less. People become more productive, right? So what do you think the market will go on average? See, so over the long run, there's only one way to go, it's up. Okay? But in the middle, it will be up and down, up and down, up and down. But over the long haul, it will be going up. But in between, it's like this. Now, so if that's the case, then Prof, that's easy, right? Put the money in there, don't think about it. Over the long period, it will be up. Yes. Is it easy to do? No. Why? Human nature. Okay? Right? Okay? So basically what happens, right? When you see a market going up, right? You say, wow, market's going up. Okay? Let's jump in and buy. Okay? Right? So this is the overconfident part. Right? And then it goes up some more. Wow, see, I told you it is right. Okay? And then you get greedy, and this is where greed sets in. Let's borrow money and buy more. If everybody is borrowing money to buy more, what happened? Okay? The noisy traders, those who are not informed, will be buying. Okay? The smart money, looking at, there's an overselling in the market, right? PE ratio on average is really too high. Okay? Because you can think about PE ratio that way. Not use it as a predictor, but you think about, what is the price earning ratio on average? It should be, let's say 20 is the magic number. If it goes above 20 points or 20, then maybe the market is overpriced. Okay? Right? Prices cannot be going up, without being supported by the earnings. Right? So it reach a point if it goes down. Right? When it goes down, what we know about behavioral finance is that, people tend to hold on to losers for a long time. Okay? Right? You buy a company share, and the company share went down, and say, don't worry, it will rebound. Okay? Worse, buy some more. right? Okay, let's average down and see what happens. Okay, and it goes further down some more, right? And then, okay, I buy even more. Okay, then you reach this point, say, oh my goodness, it's just going down. And right at this point, when it's just right before it turns the circle, because you don't know, you are really at this point, really at the bottom, you got desperate and say, okay, I'm selling everything. Okay, right? I'm dumping. Okay, right? And then it recovered. You say, it won't last. It'll come back down again, because this is your own personal bias, right? And then if it goes up again, you say, let's wait and see if it lasts. And then it goes up some more and say, wow, let's jump in, because it's coming up. By the time you jump in, what happened? It goes down. See? So instead of buy low, sell high, you're buying high, selling low. Okay? It's just human nature. Okay? So if you're chasing after stocks, don't know what you are doing, you go any investments class, stock buying tip class, they'll say, oh, this is a simple game. You buy low, you sell high, you make the money. Right? But human nature, right? Greed and fear, greed over here, fear over here, make you do otherwise. So you ended up doing this, right? The greed makes you buy at the top, fear makes you sell at the bottom, and then you should be doing, you repeat it again and again and again until what happened? Until you go broke, right? Right? So what do? Basically just park your money in some ETF, don't look at it for 3 years, right? And then 3 years later, you look at it again. Okay, now I move some into other ETFs, and then just have a very managed portfolio, and I think you should be home free. Okay, right? This game is not easy to play. Okay, the stock market game where you think that buying low and selling high. Right? Okay. Remember, a lot of people, a lot of smart money are out there thinking about this. The Prof, are you thinking about this? Well, I built my models to do this. Okay. But my models are basically for me to just, pit my expertise to the market. But do I put my real money in it? What do you think? Nah, I don't do that. Okay. See, I know better, because then I will get greedy. Okay. Right? I cannot control my emotion. That's the problem. Okay. Right. Now, so coming back to benchmark, these are just some of the numbers that we cull from the from data stream, some of the data sources, and it gives you a perspective of those numbers. But these are over short time period. The number, the 3, 4, 6, and 10, those are over extremely long period of time. Okay, right? So these are just some of the benchmark. It gives you an idea, basically, what you should be, thinking about when you think about good deals. Okay? Because the next part of the next section of this talk is I'm going to give you warning. Okay, beware of bearers, of visitor coming with gift. Okay, there's no such thing as free lunch, right? Okay, so if you look at a bunch of slides, later on they'll all be uploaded. They are very good references. It gives you an idea, see how volatile the market can be. Look at January 01 until recently. 15-year data. You look at the Singapore STI, and you look at the Dow Jones, right? You can think about, oh, if I buy here, I keep here. Wow, this is really good, right? But given human behavior, what happens? Most of us will be buying here, and then we'll be selling there. Okay, right? So what's a good strategy if you know history? Right? Just buy and keep. And keep, and keep, and keep. Rebalance it now and then. Just keep it in there, and you'll be in good shape. Don't be greedy. Don't think of, wow, I'm going to double my investment. Not going to happen. Okay, right? 3, 4, 6, and 10. On average, if you put your money in the equity market, right, over a long period of time, it's around 10%. Okay, right? Okay, so this is the bond market, and notice that the bond market hasn't been returned. And this is basically, what happened these days, because of a lot of easy money out there, a lot of liquidity in the market, right? Interest rates are very low. We are enjoying low interest rate, and people forget that interest rate in the past was sky high. Okay, just because interest rate has been pretty low, as a result, mortgage rates are pretty low. People think that housing is affordable. Okay, But if you look at the history of interest rate over time, that thing can go up. Okay? It all depends on the world economy. Okay? See? Inflation rate. Singapore versus the US. And look at what happened in the 80s and the 70s. We know in the 70s there was this oil crunch. Right? Okay, the oil supply problem, the OPEC thing, and what happened to inflation? It went through the roof. Okay, the same in the US, the same in Singapore. So, I mean, if you look at that period of time in the 80s, interest rate was double digit. Okay, these days, I mean, over the last, I think easily a decade, inflation is pretty much under control. So interest rate is pretty low. Right? So in US, you have those stimulus package, all this, quantitative easing that I think artificially forces interest rate to be relatively low. Okay? Is it going to stay this low forever? Most likely not. Okay? Right? Something will happen. Okay? Right? Oh, nothing will happen. No. Something will happen. Okay? Right? The question is, how do you protect yourself when something happens? Okay? Look at interest rate. Look at just inflation rate. It goes up, goes down, go up. And these are not, trivial numbers. They are pretty high numbers. And all this high inflation translate into higher interest rates. Okay? Which translate into higher mortgage payment. Okay? Right? So things like this that people need to think about. Okay? Okay? So always have some of these references at the back of your mind. Okay? So if you look at the return, same thing, over a short period, look at the volatility. Okay? Of this asset. But if you hold over a long period of time, you should be fine. Okay? Now, so, what to do? Okay? Mind your investment policy. Stick to the game plan. Okay? Don't change around. Don't do U-turn. Okay? Don't even look at it for years. Okay? Look at it every 2 years. Okay? Whatever your investment portfolio may be. Now, also mind your behavior. Okay? Even though it's easy to say, but this is quite difficult. It's just human nature. Greed sets in. Your neighbor makes some money. Investing in stocks, you want to get into the game. Right? Okay? So it is just the way we think about things, the way we react to things. Right? So easier said than done. Okay? Now, so mind your emotion. Many times it is the panic that people sell at the wrong time. Okay? Right? So if you don't look at it, you won't have this problem. Okay? Do I look at my portfolio? No, I don't look at my portfolio. I've got no time to look at my portfolio. Okay? Right? So I don't get stomach upset. Okay? Right? And easy to say, mind your greed and mind your fear. Okay? But see, these are all the things that comes into play. Okay? And we see all this in the data. When we mine the data, we make the data tell us what's going on to study, price movement and whatnot. We see a lot of, human dynamics. Okay? Right? People tend to take profit really fast. People tend to hold on to losers. Okay? Thinking that it will turn around. So that are phenomenon that we see over and over again in the research that we've done. Okay? Now, the third one, I can tell you, bite size. Right? Okay? 1, 2, and 3. This is the third one. Investor alert. Okay? Now, that's why I give you that 4 numbers. Okay? 3, 4, 6, and 10. Okay? That 3, 4, 6, and 10 will help you make better decision because, somebody comes up to you say that, wow, this is, risk-free, sure win. Okay? Right? You're going to make 20% if you invest in what we are offering and it's risk-free. You know that's not going to happen because Prof said that in one Saturday morning that the risk-free rate is how many percent? 4%. Okay? Inflation is running at 3%. So, okay, somebody comes and tell you it's risk-free earning 20%, then antenna goes up. Right? Right? Is it a scam? Okay? Well, if it's too good to be true, maybe it is. Right? So you think about some of the common thing that people tell you. Success story. Oh, you can make a lot of money. Oh, you can make a lot of money. Especially you have classes that charges an arm and a leg to teach you how to make money. Right? Right? Ever think about it? If the method is so successful, okay, do you think the person will be teaching you? Think again. Right? If the professor who have been researching this thing for 20 years, okay, really know how to build model to basically, beat the market, what do you think the professor will be doing? Think about it, okay? I'll be on some Greek island on a yacht, okay? Hey, I won't be here on a Saturday morning, okay? Right? So, beware of success story, okay? So the 3, 4, 6, and 10 business is pretty stable because we have looked at it over a long period of time, right? But those get rich quick, right? My model, you think about it, you buy low, you sell high, you buy low, you sell high. Wow, you can really make a good living doing that. That is one of the success story. Are there people who are able to do it? You bet. Are those people sharing their success story and how they do it? Most likely no. Right? Because if everybody does the same thing, what happened to the returns? We're gone, right? So anyway, be careful of success story. Be careful of promise of high return. That's why this morning I gave you these 4 numbers to work with. 3, 4, 6, and 10. That really gives you a kind of a reference as to, for a certain type of risk, what type of return you should be expecting. Okay? Now, so how to avoid scams? Right? Avoid scams, basically, go to MAS and look at their list and see who are the people in the list, okay? And then stay away. Right? Despite, somebody tells you, these days we live in the information age. It's so easy. Take your handphone, Google and then Google it and then see whether or not are there any warning, even though it may not be in the list, but haven't made the list yet, okay, right? So check first and go with the benchmark. The benchmark is your best defense, okay? If it's too good to be true, probably is, okay? So you learn to identify this type of characteristics, okay? Right? Remember, these people are good. It is a skill, honing years after year after year, okay, of trying to sell you something, right? They're selling you a dream because they know human behavior. They know that basically greeds take over, right? Greeds take over, and because of this innate greed that we have, of wanting more and more money, right? We fall, victim to scams, right? So one of the most famous type of scam will be this thing called a Ponzi scheme. Ponzi scheme, we've seen it before. Some promoters say, wow, I can make a lot of money for you. Okay? Put down some money. Okay, invest $100,000, okay, in January. In February, the promoter give you back $10,000. Wow. See, this thing is for real. Okay? It's only for real when you get back your entire $100,000, but you get back your 10,000. March, you get back your 10,000. Okay, and then Katie go recruit Adam. Adam invest, and then it goes on and on and on. Okay, so at the end you get some money back, and then by the time 6 months rolls around, the person disappear with the money, right? So Katie lost 70, Adam lost 90. The promoter, this is the return to who? To the promoter. Okay, so these are very type of a Ponzi scheme that is out there. So you just have to beware. Okay, right? Then there are other type of scheme, right? Some investment scheme, you can read about them. Just Google, they'll tell you basically the details on those schemes, right? And then for a while there was this gold investment, right? And so in a nutshell, basically, gold is a good asset class. As a protection. If you invest in gold, basically in your portfolio, it basically is a good hedge against uncertainty. Okay? And that's about it, because if you really were to put money in gold, right, it doesn't work that well. Okay? So remember, if it's too good to be true, okay, right, it probably is, right? Okay? And if you don't believe me, listen to what this man says, right? And of all of the things this man said, look at the last one. Okay? There is no free lunch in the world. Okay, what you only have is free breakfast when you come to money. Thank you very much.